How stocks make you money, growth versus income with real examples. Before we talk about how stocks can make you money, potentially, disclosure, because remember, when you own a stock, you own a small piece of a company. If that company has a lot of sales, say they sell iPhones, chips, whatever it is, and they make $100 million off of that, for example, but they have a cost in order to do that, a cost to operate, and say that's $80 million. Well, the difference between those two, that 20 million, is the profit. They can either take that profit, reinvest it back into the company to eventually have more sales, that's a growth stock, or they could take a portion of that profit and give it to you in the form of a dividend, and that's an income stock. So the two ways you can make money is through capital appreciation and via income. So let's say you bought Apple at $180 per share, and Apple today is at $200. Well, that's capital appreciation because your value appreciated by $20. What does this look like at your brokerage firm? You'll see an unrealized gain. You didn't really have a gain because you did not sell it. But if you sold Apple, you made that trade, then you realized it, you triggered a taxable event, then you have a gain of $20 per share, which will have tax consequences if it's in a taxable account. How does the stock price go up, you might ask? Demand. Because when you buy a stock, inevitably, you do not think the price is accurate. You think it's worth more. This is just an example, the first dividend stock that I could think of, which is AT&T. Currently, it's at $27.39 a share. It has a dividend yield of 4.05% because it pays dividends quarterly, and annually it's $1.11. Take that, divide it by the last price. That's where the dividend yield comes from. The X date is the date you need to pay attention to. This is the date you need to own the stock by in order to qualify. So the last X date for AT&T was April 10th, 2025. You need to purchase it before the X date in order to qualify. Meaning if you purchase it on April 10th, you did not qualify. But if you purchase it on April 9th, assuming that's business day, you did qualify, and you could actually sell it on April 10th and you'd still get the dividend. When do you get the dividend? On the pay date. It literally just shows up in your account. Income stocks are considered lower beta stocks. A beta of 1 is what the stock market does. Something that's lower means it's less volatile and it doesn't move as much as the market, which makes sense because it doesn't reinvest its profits and there's not as much growth here because it's a dividend stock. But what you need to watch out for, sometimes really low quality stocks are going to offer higher yields just to attract you as a buyer because that will give more demand. Inflated demand without fundamental backing make a stock price go up really, really quickly, but then it collapses. GameStop is a perfect example of this. Inflated demand just means a lot of buyers with no fundamental follow through, as in we didn't see positive earnings. Let me know what questions you want me to cover next and follow to understand how the stock market really works. And do not forget to check out my podcast, Market Maker.